Divorce-related property transfers are usually a tax non-event. No gain, no loss. The receiving spouse simply steps into the other spouse's shoes with a carryover basis. On the EA exam, they'll try to bait you into recognizing gain because the property has appreciated or because there's cash or debt involved. Ignore that. If it's incident to divorce, it's generally non-recognition. Timing matters. A common exam hook is the within 1 year rule. For divorce-related transfers, the transfer generally must occur within 1 year after the marriage ends to clearly qualify as incident to divorce. If they give you dates, do the calendar math. If it's inside the window, you're usually done. No reporting, and the basis carries over. Example style. Danny transfers a vacation home to Abby under the divorce agreement. Danny's adjusted basis is $285,000 and FMV is $550,000. Because the transfer is within a year, nobody recognizes gain. Abby's basis is $285,000, not the $550,000 FMV. That's the key. Divorce transfers don't step up basis like death does. Now switch to gifts. The default rule is also carryover basis. The donee's basis for gain is the donor's adjusted basis, and the holding period usually transfers too, which can matter for long-term versus short-term capital gain. On the exam, they'll ask what facts you need: donor basis, FMV at the gift date, and any gift tax paid. Here's the weird part they love testing. Dual basis when FMV is below donor basis on the gift date. You get a gain basis and a loss basis. For gain, use the donor's basis. For loss, use the FMV at the date of gift. And if the sale price lands between those two numbers, you recognize no gain and no loss. That middle band is the trap. Use the Noah stock example. Donor basis is $9,200 and FMV at gift is $7,000. Sell for $11,000? Gain is $1,800 using $9,200. Sell for $4,500? Loss is $2,500 using $7,000. Sell for $8,000? That's between $7,000 and $9,200. So it's no gain and no loss. Memorize that 3-outcome framework. Which of the following items does not decrease an asset's basis? The choices include the cost of defending title to the property, Section 179 deductions, a casualty loss, and a manufacturer's rebate. Think about which one is treated as a capital cost instead of a reduction. The correct answer is the cost of defending a title to the property. That's a capital expenditure, so it increases basis rather than decreasing it. A tempting wrong choice is the casualty loss, because it sounds like an expense. But casualty losses reduce basis. Section 179 and rebates also reduce basis. Marisol received 500 shares of restricted stock from her employer on March 1, 2023. She forfeits the stock unless she completes 5 years of service. The stock's fair market value on March 1st was $15,000. How much does she include in income in 2023, and what is her basis in the stock? Think about vesting rules. The correct answer is that she reports no income and has no basis until she completes 5 years of service. The stock is subject to a substantial risk of forfeiture, so it's not substantially vested yet. The tempting wrong answer is to include the $15,000 immediately, but that generally happens only after vesting, unless an 83B election is made, and it's not mentioned.